Since venture capitalist Mark Andreessen made his claims on Joe Rogan's podcast that crypto and fintech founders are being debanked by bank regulators in a scheme he called Operation Choke Point 2.0, the internet has been aflame with debate. But, while the allegations may resonate with some, the real issue could be more nuanced than that. What is debanking? The issue of debanking, or Operation Choke Point 2.0, as some have dubbed it, has recently come to the forefront of discussion among lawmakers and crypto executives. Debanking is a practice by which banks cut off ties with customers that are deemed to be politically incorrect, extreme, dangerous, or otherwise out of bounds. It's been used against a range of entities, from individuals like Kanye and Alex Jones to businesses including bullion dealers and cash handling companies. Crypto firms require traditional financial infrastructure to operate, and this means opening bank accounts. Often, these companies must undergo a complex process to ensure that their accounts won't be used for money laundering by terrorists or rogue governments like North Korea. This can be difficult, and some banks have decided that it's not worth the hassle of working with them. This is what's happened to many of the startups in the crypto space, who have found that their accounts are being closed without explanation. Many believe that this is being done by government regulators under the guise of protecting consumers. A number of congressmen have started investigating this issue, including Representative French Hill, who has written legislation to address it. New acting FDIC Chair Travis Hill has also identified the matter as a priority. Andreessen's criticism of the CFPB, combined with Musk's comments on debanking, has sparked a debate over whether or not government agencies are systematically targeting specific people and industries for their own political ends. It's important to note that there are already laws in place that prevent discrimination on the basis of age, gender, marital status, national origin, race, religion, and more. But no such laws exist to prevent banks or their regulators from denying banking services to people on a whim based on political beliefs or ideology. Regardless of whether or not Andreessen and Musk have ulterior motives in criticizing the CFPB, it's clear that they've highlighted a legitimate concern with how the banking industry is being managed. And this is a serious issue that needs to be addressed before it becomes too late. Why is debanking happening? When you talk about debanking in the context of crypto, it's usually because someone thinks that government regulators are pressuring banks to cut off accounts for people or companies that they don't like. The most famous example of this is probably the way that banks have been dropping accounts for people involved in the cryptocurrency industry, but it's not just that. It's been reported that banks are also being pressured to drop accounts for people and businesses with political affiliations or interests, as well as to close the accounts of companies that are doing things that violate existing rules. These types of decisions are usually made on a case-by-case basis, but the fact that they're being made at all is what's raising concerns about debanking. The first person to raise these concerns publicly was venture capitalist Mark Andreessen, who appeared on Joe Rogan's show in 2023 and claimed that the CFPB and other government agencies were pressing banks to close the accounts of crypto entrepreneurs, as well as those from other industries, such as pawn shops, firearms manufacturers, and miners. His claims started a firestorm of controversy, and were later backed up by other tech luminaries, including Elon Musk. At the center of the debate is the CFPB, which many argue has become too politicized and unaccountable under Elizabeth Warren. It has been described as an agency that terrorizes financial institutions, prevents new competition from emerging, and terrorizes anyone who tries to do anything innovative in finance. One of the most controversial accusations is that CFPB officials are using the agency's powers to pressure banks into dropping clients with political connections or interests, as well as those who operate in the cryptocurrency space. This is called debanking, and it's been reported that this practice has become more common since the inauguration of President Biden. Whether or not these allegations are true, it's clear that there is a growing sense of distrust in the banking system from people on both sides of the political spectrum. This distrust is making it more difficult for financial services providers to operate, and that could have a serious impact on the overall economy. What is the legality of debanking? In the case of debanking, regulators can legally make decisions that restrict access to financial services for people or companies based on reputational risk. This could include a bank deciding that it will not open an account for an eco or other crypto firm that has been linked to illegal activities like money laundering or supporting rogue governments and terrorist organizations. Financial institutions are incentivized to play it safe, given the heavy fines and reputational damage that can result from a single mistake in this area. But there's a difference between a reasonable debanking decision and one that goes too far. When banks start to make these decisions on the basis of a person's political beliefs or other protected characteristics, it is called unlawful discrimination. This can have a serious impact on individuals, particularly those who are most vulnerable to discrimination because of their social or economic status. Venture capitalist Mark Andreessen sparked a firestorm this week when he appeared on the Joe Rogan podcast and claimed that crypto and fintech entrepreneurs had been routinely debanked by US banking institutions. He fingered the Consumer Financial Protection Bureau, an agency created largely by Elizabeth Warren, as the main culprit. Andreessen's comments sparked a chorus of outrage from cryptocurrency and fintech founders who shared stories of their own debanking experiences. Many of these founders are clients of Andreessen Horowitz, the venture capital firm run by Andreessen. Some of these companies are pre-revenue, or even pre-token sale, and need to have bank accounts in order to receive VC funding and pay their employees. They can also face unfounded inquiries and notices that create costly cycles and put them under undue stress. The controversy has also prompted investigations in the House and Senate, with hearings scheduled to take place later this month on allegations that banking regulators under the Biden administration blocked crypto and fintech insiders from bank accounts based on politics. The debate is just getting started, and the issue is likely to escalate in 2022. Whether or not Andreessen's concerns are valid, he has tapped into a sentiment among crypto enthusiasts and right-wing activists who feel that traditional banks are out of touch with the needs of the new economy and are engaging in unfair discrimination against their customers. What is the future of debanking? Many individuals and businesses can take steps to protect themselves against debanking by diversifying their accounts and services among multiple financial institutions. Developing positive, long-standing relationships with their banks can also help. Finally, using alternative, crypto-based services that are designed to work alongside traditional banking can be a good way to avoid being debanked entirely. The issue of debanking first went viral after venture capitalist and tech entrepreneur Mark Andreessen raised the alarm about the problem on Joe Rogan's podcast last month. His remarks were echoed by Tesla founder Elon Musk, who claimed that federal banking regulators are shutting down the bank accounts of crypto and other tech companies in an effort to stifle innovation. Those accusations aren't without some merit. It's not uncommon for bank regulators to reassess customers' status in light of new risk-based guidelines. And some fintech companies face significant challenges in navigating the bureaucracy of government-imposed regulations that are designed to prevent money laundering and other illicit activity, as well as to shield banks from the damage that can be caused by a single bad actor or a massive scandal. What's more, if a company can't access its banking services, it won't be able to process payments, pay employees or convert digital currency into fiat money. As a result, even if a business is operating legally, it could find itself in trouble. In the case of crypto companies, some say that the government is targeting them because it fears their technology will make it easier for criminals to launder money. But critics argue that these allegations are based on a false premise, and that government officials are simply seeking to protect the public from the risks associated with the nascent industry. Whether or not these claims are true, the debanking debate has opened a broader discussion about how the government should balance the competing needs of innovation and financial inclusion. In the future, policymakers will need to strike a delicate balance between these goals and continue to provide protections for small businesses while ensuring that consumers remain protected.